Binance Margin versus Futures. What is the difference between them? What are the fees and which one should you choose? Welcome back to the channel. I am How to Buy Bitcoin, and to start things off, we'll talk about the similarities between those two Binance modes. So basically they are the same thing and allow you to use leverage to increase the purchase power of your position. But the similarities kinda end there. While the Binance Margin happens in the spot market, the futures has its own little world on Binance Futures. That means that the trading fees, available pairs, leverage, and funding rate will all be different. So let's compare them side by side. Number 1, trading fees. The margin trading fees will be higher since they are traded in the spot market. We will be using market orders for our example. They will be anywhere from 0.1% going as low as 0.055% if you sign up with the best Binance referral code, link in the pinned comment, and also pay with BNB. While on Binance Futures, that fee will be lower at 0.04% going as low as 0.032% if you use the Binance Futures referral code also in the pinned comment and pay with BNB. So that's a point for Binance Futures. Number 2, available pairs. A big advantage of using margin over futures is that you have much more spot trading pairs to choose from than on Binance Futures. This allows you to trade smaller coins with leverage that are not present on Binance Futures, and even curious trading pairs such as trading between stablecoins. One example where this could be useful was in the Terra Luna collapse. You could trade UST against Tether and profit in that specific situation. That's what I did on Binance Margin, and that netted me a nice profit. While on Binance Futures, you are kind of restricted to the futures pairs that are available for the larger coins. So that's a big win for margin. Number 3, leverage. The leverage you can use also changes depending on which platform you will trade. On Binance Margin, you are restricted to 3x on cross mode and 10x on isolated. On Binance Futures, on the other hand, it can go as high as 125x, and of course, the higher your leverage, the more likely you are to get liquidated. So I give this a slight win for Binance Futures, but if you have a sound strategy, 10x leverage on margin will be more than enough. Number 4, funding rate. On Binance Futures, the funding fees are quite predictable. For example, if you borrow USDT, you can expect to pay 0.02% of your borrowed position per day. On Binance Futures perpetual contracts, the funding rate is unpredictable. It can go extremely high, it can go extremely low, and changes over time. But using the standard rate of 0.01% every 8 hours, you can expect to pay around 0.03% per day. So I give this a slight win for margin for the lower amount and because it won't surprise you like on Binance Futures. In conclusion, it really depends on your strategy and how you trade. If you are scalping and you need to buy and sell often, Binance Futures probably will be the best for you. If you are holding a position for a longer period, you can expect that the Binance Margin will be more predictable and probably cheaper in the long run. Also, these platforms have different UIs and it really comes down to preference. I used both with moderate success, and I believe the more important aspect here is which one do you feel more comfortable with. And remembering that leverage is only for advanced traders with a clear strategy. Don't forget to sign up on Binance or Binance Futures using the link in the description to lower your Binance trading fees. If you found this video helpful, hit the like button and I will see you in the next Binance tutorial.